Hey everybody, welcome to another episode of Docs Investing RX, where I help coach you to financial success. Now, I've got something exciting in the works that I can't wait to share with all of you. A lot of you have been asking, how can you support me and the work that I do and get even more value out of what we're building here? I'm putting together a brand new way for you to do exactly that. Very soon, I'll be launching an exclusive community for all my supporters. Think of it as your VIP pass, where you'll get access to bonus content, behind the scenes insight, and some really fun extras that I won't be sharing anywhere else. And the best part, you'll be directly supporting me so I can keep making things bigger and better for you. I can't spill all the details just yet, but trust me, you're going to love what's coming. Keep listening. I really enjoy reading everybody's support and learning from the criticisms, both positive and negative. But soon I'll be revealing those details and how you can join in. This is just the beginning, and I want you to be part of it from day one. Also, one other piece of exciting news is that I am working on a new podcast series called From Broke to Wealth. And it's going to be a super cool series talking about how the system is set up against us in order to keep us from becoming wealthy and the ways and tools to grow and succeed and turn our lives around. Because a lot of us have started from the bottom or are struggling or trying to make our way up because we all want the same thing. We want financial security for ourselves and our family, our loved ones. And so my goal with that podcast is to give you those tools in order to succeed. I appreciate all the comments, the likes, etc. Now, let's go ahead and dive into today's episode. It's called bottom feeding. Now, we see these stocks pull back, tank down, but how do we know which stocks to jump into? Some companies are just failures. They're literally pump and dumps. Other stocks have just suffered a setback. And a couple of the big ones that I jumped into over the past month, and those who follow me on After Hour know, are Eli Lilly and UNH. Now, UNH made huge headlines, obviously, over the death of their CEO. And the loss of the CEO was just one step in a domino effect of the fall of this great company. Now, if you've looked at the chart of UNH over time, it is a path upwards. After this devastating event, the company has sort of spiraled out of control. The company is sold off. Everyone's talking about it in the media, the government. They're talking about healthcare cuts, etc. And so the stock started to decline. Now, we went from a company that's in the top of the S&P index, one of the top companies in America, pulled back, not necessarily because the company was failing as a business, but because of outside pressures. It's important to realize if you look at the charts that the stock didn't just tank to its bottom in one day. It was a multi-day approach. And that's one thing to remember is that if a stock is going to pull back, it can go anywhere from within a few minutes and then bounce right back, or it could take several days. So a safe thing to do is to wait at least about 3 days to make sure that there isn't more potential downside. If you continue to see the stock to pull back, you want to see it steady for a few days or at least see buyers come in. UNH has been in the news for a whole host of different headlines. None of it was good. So let's focus on a company that is one of the top companies in America. And yet here's this company that has fallen from grace. Now, all we have to do is look past the headlines. What we care about is the chart. We want to know what the stock is doing. We don't really care about the headlines and all this other stuff because it's fluff, right? People, the insiders, know what's happening before it hits the news. Now, with UNH, the big thing to note is this is a huge conglomerate of a company and it suffered a pullback. Let's dive in and take a closer look at why I decided to jump in. One of the key metrics I look at is your exponential moving average, and this is your daily exponential moving average over 8 days. If you notice that UNH, since it hit its highs back in the 600 plus, it has been a downward snowball of effect. However, if you looked and noticed that after it made its high of $602 back in April 11th of 25, that it suffered 3 red days just before earnings. And so that's an interesting note, right? You notice that it would open and then close lower, right? And the next day it would open and close lower. So it did that 3 days in a row. And that's one sign that after making highs again, that it's starting to pull back right before earnings. So that could have been a good time, say maybe insiders are selling, right? Some of the big wigs are selling into the pressure instead of making new highs right before earnings, it's starting to sell off. And that's people taking profits. And if you are a long-term person of the company, this could be a good time to maybe sell a little bit to take some profits off. Because sure enough, once the earnings came out, the stock tanked down to sub 500. So if you were still in the stock, you lost quite a bit of money. Again, if you're a long game, you're looking beyond the day-to-day motion. However, for a lot of people, that's a huge deal, right? Every dollar matters to us. So if you looked that as soon as it blew down on earnings, it bursted through that 8-day EMA. And for a long period of time, it didn't reclaim it until it bottomed out at 247. Then over the next couple of days, it struggled to reclaim and then eventually did move above the 8-day EMA. And it did it for a short period of time. And again, you notice that once it started reclaiming a new high again, it was like 326. It opened the day and then closed below the 8-day. And that would have been in time, you know what? This company is not making new highs, not making progress. Let's just sell and wait it out. And if you made that move, you would have noticed that the company continued to decline all the way to a new low of 234.60. And that low was hit on August 1st. But after that day, if you just continue to wait until you kind of see that 8-day, and sure enough, it reclaimed it within a week or so. So August 8th, it closed above the 8-day EMA. And if you were able to buy that day, that was around 250 again, similar to the low that it hit when it pulled back the first time. And since then, it's been on a climb. And sure enough, Warren Buffett revealed his purchase of this company. And again, the Warren Buffett approach, buy companies that are beaten down and undervalued. And United Healthcare, if you don't know, is one of the largest healthcare providers in America. People are members of this, and the company's not going anywhere, right? Because if they go under, they're going to have to get health insurance from somewhere else. So this is a well-established, big-time company, and that's why I decided this would be a good one to buy. This isn't some SPAC of a small-town company that you're not sure if it's going to be around in a few years. Health insurance is not going anywhere unless the government is expanding health insurance. And guess what? They're doing the opposite. So the next question is, how long do you stay in UNH? Again, Warren Buffett's method is buying them when they're undervalued. This is a stock company that was $600 a share and then pulled back after earnings. So you can say, well, as long as we're above the 8-day average, things are looking rosy. And that's my guide. Because if it starts to fall under the 8-day, that means, you know what, the momentum has shifted in the opposite direction. So if you're a sort of a swing trader, day-to-day trader, this could be a time to maybe pull the plug on it. But again, if you're in it for the long haul, then trim some profits, ride the rest in shares. Now, there's a couple other ways that I approach this. You can do shares, you can do leaps, which are call options that are extending beyond 1 year. Because again, a company turnaround can take several months to years. So you don't want to play with short-term call options unless you're literally be following the stock day to day. The other thing I did was sell puts. Now I talked about this on previous episode and I looked at the stock chart and figured that if the stock hung around 250 and bounced the previous time, that 250 would be a good support. But again, it went down to 234. So it was a little dicey, a little hairy, but I sold the $250 puts again for several months out and collected premium. And so that money that I collected from the premium helped offset the cost of the leaps and the shares that I bought. This is called a risk reversal, right? So I'm doubling down. I'm using selling puts, which is a bullish move. And then I bought shares and calls again, which is a bullish move. And so the combination of both is counting on the reversal of the stock. And it's basically a double dip. It is risky, so if it's something that you can't afford, if you get called away on those puts, then you should consider a put spread whenever you decide to sell puts. I know that's a lot of information to take in, and I apologize. And that's another reason why I want to try to consider moving beyond just the podcast and provide a little bit more personalized information. I'm hoping to do that soon. Now, let's go ahead and move on to Eli Lilly. Eli Lilly is this phenomenal company. Their bread and butter are this GLP-1 inhibitors, but they aren't the only one that create this drug. And so there is competition out there. But because of this and the popularity of these meds, it has been on a complete tear. And it actually reached up to a high of $967 back in August of last year. Since then, it has been a slow decline. It's been volatile up and down, but it hasn't been able to reclaim that high. A phenomenal company, big time player, big weight in the S&P 500 index, but on the decline. And if you look at the 8-day and even the 21-day EMA of the daily, it has been a downtrend since that high. It did eventually start to turn around and make it up to $933. But if you followed that scenario and you sold when it started breaking down from the 8-day, you would have sold back at $930. But let's focus on when I jumped in, which is more recently. If you just look back to just a few weeks ago when it was at $820 back on July 28th, it fell below the moving average. Again, 8-day and 21-day, and never really reclaimed it going into earnings. Again, not a good sign. Why is the stock selling off going in? And this could be some insiders slowly dumping the shares, these hedgies positioning themselves, taking profits off the table. So if you are long, you can always start taking some profits off yourself. Now, sure enough, the earnings, they were actually pretty good, but the stock tanked and bottomed out at $622. And this was important to realize that if you wait the 3 days, you can safely see that the stock did indeed bottom out. And if you decided to start picking up some shares at that point, you'd be up considerably at this point. But again, this is a big time conglomerate. You have to figure out whether or not this conglomerate is still fundamentally sound. Is this a company that's going to continue to do well in the long term basis, or is the company now broken? Are the fundamentals broken? You look at UNH, you look at Eli Lilly, these are solid, big time companies that have setbacks and they'll turn it around. Another great example is Amazon. Amazon for years was not really pumping out profits. They kept reinvesting in the company and the company was a little stagnant. But again, reinvesting itself into the company and not necessarily becoming profitable turned out to be the best for Amazon. Tesla, another example. It wasn't profitable for years, but if you stayed patient and said the long-term game is still sound, you'd be up a lot of money right now. The main message of this episode is that bottom feeding can be a very lucrative time to jump into stocks. This is essentially the Warren Buffett approach. Finding a good company with solid fundamentals that just suffered a setback, something that's undervalued. So with that said, it is risky. There are further downside risk, and maybe there's something broken with the company that you're just not realizing. So I'm not saying to ever go YOLO on such things, but it may be worth a small position, right? And you can always consider providing some protection for further downside as well by buying puts or selling a put spread, what have you. Anyways, hopefully this information has been pretty helpful. I know it's a lot to take in, especially over a podcast. And again, part of that project that I'm working on coming forward with that community, I'll be providing a little bit better insight and be able to write things out so it'll be a little bit easier to follow. But for now, again, I post a lot of free stuff on After Hour itself, the free stuff here on the podcast. And again, stay tuned and hopefully you've learned something from this episode. Be sure you like, leave a comment, subscribe. Much love to everybody here. I wish you the very best into your financial success. This is Doc. Until next time.